Hey, it's Rob Weinberg, and on this channel, we empower people to take control of their futures through expert mortgage, financial, and real estate strategies. If it's your first time watching us, go ahead, hit that subscribe button, and smash the bell so you get notified on all of our future content. In today's lesson, we're going to talk about cracking the mortgage code and some secrets that you can use to qualify for a mortgage quickly and easily. So the first thing I want to discuss is common reasons that mortgage applications get rejected. Number one, insufficient income. What that means is that the amount of money that you make is not enough money to support the mortgage that you're looking to apply for. Number two, unable to document income. What this means is that you may make a certain amount of money, but you're not able to document that. Maybe it's under the table or it wasn't reported correctly as profit on your tax return, that sort of thing. The next thing is going to be high debt to income ratio. So this means that the amount of debt that you have is too high based on the amount of income that you show. Now, this could be that you could afford the mortgage, but it's the other debt that you have, like credit cards, student loans, auto loans, personal loans, etc. And those other loans are causing your debt ratio to be outside of the approvable amount for the specific loan program. Next one's going to be low credit score. So most loan programs have a minimum credit score that you need to meet in order to qualify for that. For most loans, it's somewhere around 580 for a lot of government-backed loans and 620 for Fannie Mae, Freddie Mac loans. Also, non-QM loans are usually in the 620 to 640 range as well, depending on the lender. So if your credit score is below the minimum for the loan you're applying for, your loan application will get rejected. Low equity or not enough down payment. So most loan programs do have the minimum down payment amount. For FHA, it's 3.5%. VA, it's no money down. USDA, no money down, and then conventional is typically 3 to 5%, depending on if you're a first-time home buyer or not. Now, these are outside of any down payment assistance programs or anything like that, but if you're applying for, say, a conventional loan with 3% down and you only have 1% down available, then your loan application could be rejected because you don't have the sufficient amount of funds. You don't have a large enough down payment to meet the requirement for that loan program. So these are the most common reasons why applications are rejected, but how you can avoid issues is every single one that I've given to you and talked to you about could be overcome or at least strategized on with an advisor. So what you want to do is figure out who your knowledgeable advisor is going to be when it comes to getting a mortgage and during your real estate transaction. Someone that understands the guidelines, has the reviews and experience to really help you through this, and then you want to work on getting the issues that you have ironed out before you're ready to apply for the mortgage. So really what I'm talking about is if you're going to be ready to buy a house in January, you think, well, then talk to a mortgage advisor a couple months ahead of that. So like if January is your timeline, talk to a mortgage advisor in September, October, if not earlier. At least a couple months ahead. So if one of these issues is going to be a problem, we can rectify it before you're ready to roll and moving forward into the process. You want to get these ironed out before you apply, and you want to also understand that sometimes a creative solution may need to come up with, and it may be a two-step process where we need to say to you, hey, you need to handle this, this, and this, and then we can do the full loan application here moving forward and get your pre-approval done. So don't look at that as a bad thing. Look at that as just one more step on your path to home ownership. And again, who you work with matters, as I always say, so you want to handle that with them up front to make sure that you're moving in the right direction. So that's the common reasons for rejection and how to alleviate some of that here. The next thing I want to talk to you about is credit and DTI strategies. DTI stands for debt to income. So these are a couple areas that I really focus in on with a lot of my clients up front, especially if they're looking to afford a property that maybe is at the high end of their price range or even above what they're currently able to do. So what we want to really focus on here is your credit score. How do you get your credit score up to the best possible score before you apply? I'll tell you, squeezing out every point, yes, you want to try to do it as best you can, but don't stop the home buying process or just throw out the idea of buying a home just because your credit score may be on the lower end. As of right now, most of the programs are 580 or so for government-backed loans, 620 minimum for Fannie Mae, Freddie Mac loans. And if you're doing a non-qualified or investment property type of mortgage, you're going to be looking at typically around a 620, but more than likely a 640 or higher for those. So even if you're at the low end, if you meet those thresholds, if your lender has the ability to get you a program, you want to move forward. But what can you do if you're before that to help optimize your credit score? The number one thing I've found working with thousands of clients over the years is your revolving debt. Getting that revolving debt percentage as low as possible. The strategy that I use is 50, 30, 10. So what 50, 30, 10 refers to is 50% of the limit, 30% of the limit, and 10% of the limit. These are the thresholds that you want to get your credit balances to in order to optimize your credit score. So when you're using greater than 50% of the limit on any credit card, it's going to start whacking your credit score pretty bad. And 50% is just a starting threshold, but if you can get it to 30% of the limit, so on a $1,000 credit line, 30% would be a $300 balance or less. If you can get it to that or less, it's going to give you more points. And ideally, if you can get that credit balance down to 10% of the limit or less, so on a $1,000 credit card, that's a $100 balance or less, that's going to really maximize your credit score. So if you know you're going to be going to apply for a home loan in a couple months, do these 30 to 60 days ahead minimum, because it will take a little bit of time, generally 2 to 4 weeks for whatever you do today to actually report onto your credit. So if you know you're applying, pay down some of that revolving debt. That's really the best thing you can do to get your credit score up. Now, as far as debt to income ratio, this is a tough one because there's only so much you can do if you're getting ready to apply for a mortgage to get your debt to income ratio down. The best way is to pay down debt, obviously, but if you're getting ready to buy a home, you may have limited money available to actually pay down your debt. So you want to get it to the thresholds I said, like 50% of the limit on the credit cards is a great place to be. You want to look at potentially increasing your income with your current employer. Maybe you can get a raise, and if we can get a documentation of that raise and when it's going to actually happen and be in effect, in many cases, we can actually use that raise for your loan qualification, for your pre-approval. So that's something that a lot of people don't realize that you can do during the loan process is get a promotion or get a raise with your current employer, and we can use that to actually get your loan approved. Now, I caution you if you're thinking about getting a second job in order to increase your mortgage approval. Second jobs are a slippery slope because when you have 2 jobs, you actually have to have both of them for 2 years in order to use that income from both of the jobs. So I have had people that are not happy with their current job simply go out and look for a higher paying position in the same field. And I've had many home buyers that actually switch jobs right before or with my permission during the pre-approval process if we've talked ahead about it. If it's a salary job and we can document it properly, then it actually could help you to get pre-approved for a higher amount. This is something you really want to discuss with your mortgage loan officer directly because every program is going to have different guidelines. But increasing your income and lowering your debt is obviously a main area that you can use to help your pre-approval and help just move things along and crack that mortgage code for your situation. Now, streamlining the process is something I want to just touch on for a minute. So streamlining the process is all about making it a stress-free process for you and everyone involved when it comes to buying a home. Finding the house and negotiating is tough enough. So when it gets to doing the mortgage process, you want to make that smooth. How do you do that? Number one, you want to have your documents ready. We'll go over the documents you're going to want to have in a minute, but having those ready is going to make it a lot easier and less stressful once you're under contract on a home. Have your funds available. Know where the money's coming from that you're using to buy the home. That's really important. And get a lender relationship early on. Don't wait until you're ready to start home shopping to actually get with a lender. You want to absolutely talk with at least 1 or 2 lenders a few months before you're ready to make sure you have all your I's dotted and T's crossed, your credit's where it needs to be, down payment, all that stuff is exactly where it needs to be. So if you need to make changes, you can do that without being stressed. So those are some ways to streamline the process. As far as documents needed, you're going to want to get a checklist from your lender. There are some specific documents that should be pretty routine and streamlined between all different lenders, or uniform, I should say. So if you're a W-2 employee, then your driver's license, your last 30 days of paycheck stubs, 2 years of your W-2 forms, that's going to be generally what you're going to need to document your income. If you're self-employed, we're going to want the last 1 or 2 years of both business and personal tax returns. And for all loan programs, we're going to want 1 or 2 months bank statements, as well as quarterly retirement statements to show your assets. Also, with all loan programs, we're going to want all divorce paperwork that outlines any child support, alimony, that sort of thing. And if you already own multiple properties, have mortgage statements available for other mortgages you have, as well as your property tax bill and home insurance bill if it's not included in your mortgage. You're going to need to show that to your lender during the home buying and pre-approval process, so you might as well get it done up front and have it ready to go. Now, the next item I want to touch on is pre-qual versus pre-approval. Now, you can really help yourself out by getting a full pre-approval when you go to buy a home. A lot of lenders now, they're trying to cut corners and save time and save money, so they just do a quick questionnaire and then they pre-approve you. Sometimes they may not even have looked at your credit report on a pre-qual. They'll just go off what you say your credit score is. If you say it's fair or good, that's what they'll go off. If you say you make 50 grand a year, that's what they'll go off. That's not what you want, though, as a home buyer. You want a fully vetted pre-approval, because that's going to really make it look and show that you're eligible to buy this home, that you've done the work and the due diligence, and that your lender's gone that extra mile to make sure that all your documents are in order. Everything's in line, buttoned up, and ready to move forward full speed ahead. So make sure that you're getting a full pre-approval when you move forward with the home process, and talk to your lender about it and question them if you're not. Make sure it's a full certified pre-approval with all your documents supplied. And the reason that's important is because it's going to help stop potential issues from coming up during the loan process after you're under contract. So that's huge. Get those issues out up front. Get them ironed out before it becomes a stress and a problem. All right, the last thing we're going to discuss here now is going to be myths in the home buying process, misconceptions about the mortgage application process that can trip up home buyers. So one big thing is how difficult it can be and the paperwork involved. Nowadays, with technology, if you're working with a tech-enabled lender like myself, we can actually get most of the documents needed fully electronically, and by preparing you up front with a thorough checklist, you can give us everything at once, and we can be, again, very thorough and make sure that we don't have to keep coming back to you for more and more documents. So it really can be streamlined from the standpoint of the paperwork. The next things is timelines. You know, you might have had a friend or family member where it took them 3-4 months to buy a home, but that's definitely not the norm. Our average closing at my company is under 30 days from when we get that contract in until you get the keys to your home. Okay, 22 days to be exact, but generally under 30 days is what you can expect. So the home buying of today is different than 5-10 years ago, and we didn't have all this technology to help move things across. One important thing is setting expectations up front. So based on your sales contract, that's what's going to really tell when these timelines have to be met. So we can set expectations with you so you know, here's when my loan final approval should be out. Here's when the appraisal should be back. Here's when we're going to hit these deadlines, so you're not just out there in la-la land wondering what's going on. And that's really about setting expectations with your lender. There's a huge myth out there that you need like a 700 credit score or higher to buy a home. That's a huge misconception and myth. I've helped people buy homes recently with as little as a 580 credit score. So I'm telling you right now, it can be done. You just have to get with the right lender that has those right programs. How much you need for a down payment. Many people still today think you need 10 to 20% or more down in order to buy a home. And there are programs that will allow you 3% down, and even some like the VA or USDA loan that allows 0 down. All you have to come up with is your closing costs, and in some cases, the seller can even chip in on those. So you can get in homes with 3% down or less in many cases. Don't let that down payment discourage you. Get with a lender, figure out your specific scenario, and then create a game plan from there. So the last thing I want to talk to you about is just getting a game plan early. 6 to 12 months ideally ahead of time before you're ready to buy a home. That's really, in a perfect world, when you should be networking and collaborating with a lender, and then let them guide you to a realtor from there once you're fully pre-approved. So that's what I recommend. Those are some things that you can use to crack the mortgage code and make it a smooth and easy process for you. Now, I'm happy to assist if you're someone that's buying a home or looking to buy in Connecticut, Massachusetts, or Florida. Those are my 3 licensed states. If you're outside of those states, I can refer you to a colleague. But if you're in one of those states and you're looking for my personal help, I do offer one-on-one consultations where I can actually be the one to walk you and guide you through this home buying process. You can reach me directly by call, text, or private message. My direct line is 860-413-3938. As always, I hope that helps, and we'll see you on the next episode. Take care.